Hello and welcome to today's video, which is called Bleeding S&P 500. For sure it had been bleeding for the last couple of days, and I'm pretty sure as well that you have noticed the great results that I have been presenting on Twitter when it comes either to swing trading or to our great intraday stock market channel, where we feature both S&P 500 and DAX. Make sure that you are subscribed on my site to the daily analysis widget, grown in size and in content, as I am spending more of the time preparing these and talking with clients on the Telegram premium channels. So make sure, and I hope that as you are listening to this, that you are already enjoying this information in real time. So let me invite you to join as of November 1st our Patreon. So let's move into the big picture for stocks and the real economy. Friday was another day of rejection at the 4,180 level, and no overnight bounce did hold. Core PCE, having come more or less in line with expectations, only marginally hotter, did not trigger sticky inflation fears, meaning that bond yields did not surge. However, if we compare to prior weeks, the steepening of the yield curve is progressing, is alive and well, and that serves as some kind of a countdown to recession, which is not on our immediate doorstep. We haven't seen top in yields. The 5.1, 5.2 percentage points on the 10-year is only chart resistance. Next level would be 6%, but I doubt we get there in one go, and rather would be looking at the bond market trying to reverse as for signs regarding the upcoming recession timing. We also see the dollar still strengthening, and it would continue strengthening. We have had the breather already playing out, and now the dollar is readying a fresh upswing. Global liquidity and credit creation, sorry for the typo, are quite negative, and this contributes to the tight financial conditions, the deteriorations we are seeing in there. But Friday was still the day when no landing narrative ruled, and that was certainly as positive as the strong Wednesday's new home sales data. Overall, the bond market is still getting it wrong about returning inflation, about us moving from sticky inflation to a new inflation wave. That would happen as we progress through autumn. Overall, summing up, the Fed is trying to remain restrictive, keep the Fed funds rate elevated as much as it would be allowed to by the bond market, because the bond market would be doing the tightening, and it would be also in reflection of the stark volume of fresh treasuries issuance and the debt that needs to be rolled over. When it comes to stocks, third quarter earnings haven't been really bad, and sales and forward guidance had been kind of disappointing at times, but earnings are holding up pretty well still, which would serve to underpin stocks for the fourth quarter later on. Consumers are still doing okay, even if it comes at the expense of rising credit card balances, and manufacturing is practically coming back to neutral, and this is a very positive sign and one of the cornerstones of economic acceleration and no landing narrative already mentioned. So we are seeing a really steep, over 10% correction from the July highs in the stock market, and it's still my view that the fourth quarter will be looking better in stocks. But of course I will let clients, whether swing trading ones or intraday ones, as to when I see that next stock market turn happening. So stay tuned to the daily articles and also to the great successes that we are having in the intraday channel. So let's dive into a couple of stocks that I have been featuring lately. Tesla was my shorting candidate, and the move is unfolding pretty well. It's gently rolling over to the downside, and the target still hasn't been reached for now. The volume says that we may get some kind of a consolidation, not outright downswing continuation Monday, but I doubt that the move would stick. Another one that I had talked in the last 10 days was Bank of America. Big banking in general is vulnerable, and it depends only on the individual chart that you are looking at, and Bank of America belongs among the weaker ones. JP Morgan and Wells Fargo are looking somewhat differently, and this only confirms my over a week ago call for financials to underperform. Even if they are cyclicals, they would not be staging the return in this stock market rebound. They would be not participating with any kind of veracity. And now one of the other great picks and successes of Friday was my call for gold on the intraday channel to break 2000. It happened, and it happened. Clients basically had over 4 hours to prepare for that move, which coincided with the Israel announcement. For now, high ground is being established. Volume is not totally great, so I expect more consolidation of the high ground and definitely no continuation of this steep upswing with the same speed. So these are even if miners are turning up, so I would disregard that. So these are the key learnings when I picked a few select stocks and took a dive into precious metals. I'm covering all of these markets on a daily basis within the articles, so make sure that you are familiar with way more than the free version. Obligatory disclaimer, and have a fine weekend.